Get ready, because what just happened in the financial world is the kind of event that only comes around a few times per decade. Just a few hours ago, the Federal Reserve made a move that sent shockwaves through the entire economic landscape. For the second meeting in a row, they lowered interest rates, marking the beginning of a full-blown rate cut cycle. This cycle fundamentally reshapes money, markets, debt, housing, and everything in between. If history is any guide, once a cycle like this starts, there's no easy undo button. The last time something like this happened, it triggered a chain reaction. Asset prices soared, debt levels exploded, and liquidity flooded markets. It was basically like turning the money printer from off to warm up the engines, and now the dial has officially been switched to on. Today we're diving deep into what the Fed just did, why Jerome Powell is sounding more cautious, and what this means for your money, investments, job, and home. Most importantly, we'll discuss how you can position yourself not just to survive this, but to profit from it. Because this is definitely not a moment you want to sleep through. Now, at first glance, rate cuts seem weird. The stock market is near an all-time high, crypto is partying, gold is shining, and real estate prices are still elevated. So why is the Fed stepping in as if the economy needs help? The Federal Reserve's entire job is based on balancing two things: keeping employment as high as possible and keeping inflation from spinning out of control. But the government shutdown threw a huge wrench into this balancing act, causing major delays in national economic data. For the first time in more than a decade, the Fed was flying partially blind. When data goes dark, the Fed turns to alternative indicators, and those indicators are flashing big warning signs. Consumer spending is softening around the edges, and Powell himself admitted that both supply and demand in the labor market have come down faster than anyone predicted. Which is Fed speak for: the economy is slowing down, and we have to act now. Rate cuts, in theory, help soften the decline. They lower borrowing costs, make it easier for businesses to hire, boost lending, and support asset prices. But markets don't move on theory, they move on reactions. And oh boy, the reactions are already showing up. Let's talk stocks, because this is where everyone is staring. The S&P 500 in 2025 has been absolutely crushing it, up more than 30% from the April lows. Over the last 5 years, the market has basically doubled, which is like getting a 15% annual return every single year. That's not normal. That's not even above average. That's winning the genetic lottery of investing. And yet, analysts are torn. On one side, optimists like Bank of America and Morgan Stanley say we might go up another 8% in 2026 and hit 7,200. Why? Corporate earnings are strong, AI adoption is spreading, productivity is rising, and consumers keep spending. On the other side, realists like Goldman Sachs and JP Morgan warn these returns are not sustainable, expecting smaller growth. Goldman thinks the next decade will average around 3% returns, while JP Morgan says maybe 6%. But here's the twist. None of these forecasts matter as much as the relationship between markets and Fed cuts. Historically, when the Fed cuts rates while markets are near all-time highs, the stock market tends to rise over the next 12 months, 93% of the time, averaging a 13% return. Sounds incredible, right? Well, there's a catch. Right after these rallies, markets often get extremely volatile. We're talking sudden 15 to 20% drops, sharp swings, mini panics, moments that make you check your portfolio the way you check your bank account after a night out. Historically, the largest market crashes of the past 20 years have happened after the Fed begins cutting, not before. Not because cuts cause crashes, but because the reasons for the cuts finally show up in full force. That's why investors need to walk a very delicate line. Expect the best, prepare for the worst, and manage your expectations. Personally, I'm planning long-term around 4 to 6% returns. If I get more, great. If I get less, I'm not emotionally devastated. That's how adults invest. Now buckle in, because housing is where things get wild. First, the good news. More inventory is coming. Home sales are expected to rise 10% in 2026, and mortgage rates are slowly trending down. National home prices are cooling. Finally, S&P Global says home prices dipped slightly month over month and are down a bit year over year. But, and this is a big but, you should not expect 2008-style discounts. Why? Because cash buyers are everywhere. Over 30% of buyers now pay in cash, and the average down payment just hit a record $70,000. Half the country is struggling to buy a house. The other half is buying houses like they're grabbing extra bananas at the grocery store. Price changes also vary dramatically. Homes between $350,000 to $500,000 see the most price cuts, while luxury homes barely budge. Deals are falling apart more often, around 15%, mostly due to home inspections. Buyers are less desperate now, they're willing to walk. Anecdotally, even though the national market is cooling, well-priced, well-presented homes in good areas still sell fast, often with multiple offers. Real estate is no longer about timing. It's about strategy. Inflation is still slowly cooling, but prices for everyday essentials are stubbornly high. Groceries, rent, insurance, utilities, they're all squeezing your wallet. This is why cutting costs matters more than ever. And one of the easiest places to save money is the phone bill. Now let's zoom back out to the Federal Powell's latest comments make one thing very clear. The economy is slowing faster than headline numbers suggest. That doesn't mean recession is guaranteed, but it does mean we're entering a phase of the cycle where cheap money is returning, volatility is increasing, and liquidity is rising. Debt loads are growing, markets will act weird, and asset prices may surge. And patience will become your best investing skill. Rate cuts don't fix problems. They buy time, reduce pressure, and stabilize weak spots. But they also distort prices, attract speculation, and encourage risk-taking. Which is why the next 12 to 24 months will be filled with both incredible opportunities and potential pitfalls. So how do you protect yourself and profit? First, don't chase high returns. If the market gives you 5 to 7% annually, that's historically strong. Anything above that is bonus. Second, avoid timing the market. Most people who try end up worse off. Third, keep extra cash for volatility dips. Rate cut cycles often create incredible buying opportunities, but only for those who are ready. Fourth, if you own a home, don't panic. Prices may cool, but this isn't 2008. It's a normalization, not a collapse. Fifth, if you want to buy, watch mortgage rates closely. Every 0.5% drop adds thousands to your affordability. Sixth, if you invest in AI, tech, or growth stocks, buckle up. They tend to benefit from lower rates, but can swing violently. Seventh, diversify. Nothing complicated. Stocks, bonds, cash, real estate. Simple, effective, boring. The financial equivalent of eating vegetables. Eighth, stop panicking at every headline. Rate cuts are neither doomsday nor all sunshine. They're just part of the cycle. Right now, we're transitioning from tight to looser, from high rates to normalizing rates, from data-rich analysis to read between the lines analysis. It's going to be messy. It's going to be unpredictable. It's going to be dramatic. But if you're informed, truly informed, you'll come out ahead. Subscribe, share, and like the video.